Hey, welcome to the podcast, everybody. Thanks for joining me. Well, the stock market continues to move up, as you can see from the S&P 500 here. And we talked about this the last few podcasts, that probably was going to at least test this old high, and it is, in fact, done that. So I guess the question is, should we stay or should we go? Like the old song says, and I think, you have to let the prices dictate that. I think too many people right now are trying to outguess the market and selling when they think it should be rolling over. And what ends up happening is you sell out too early, and then the market runs up, and then you're caught not knowing when to get back in. So the thing to do is, again, and I mentioned this before, have your systems in place so that when the market does roll over and certain triggers happen, then you go ahead and take your profits, or in some cases get stopped out, whatever the case may be. But that's the big picture. Now, you can still be doing trades and buying individual securities that are beaten up, or take profits on things that have been extended. But as far as the overall market, and you're looking at your overall kind of stock allocation, right now the bottom line is that there's still more demand out there than supply, and the market continues to go up. It seems like every day we hear about more and more, bearish hedge fund managers or kind of doom and gloom guys being converted to bulls and saying, well, I'm finally going to get my cash invested. I kind of give up, which is a little scary because that's a little contrarian, isn't it? But look, I think you do have to go with the trend, and a correction can happen at any moment. And if you try to anticipate it too much, again, you're going to be whipsawed. I mentioned a couple weeks ago that I had sold my financials during this little downdraft right in here, and it was a little too early. Fortunately, that next couple of days, once the market reversed course, and we had shown this on an hourly picture, and I'll show that to you. I had drawn some lines and said, it's logical that this thing is going to roll over because it was in this pattern, and it did start to sell off, and then it broke out. Once it breaks out, on the first of the month, I actually went in there and bought small caps. I bought utilities back, bought some more S&P 500, so just got more exposure into the market. And since that time, of course, the market has gone up because I had my discipline in place to say, hey, it could have rolled over there, but when it didn't, I quickly reversed course and got back on the winning side of the trade. Now it's very logical that you would say, hey, this thing is going to roll over now. Shouldn't it roll over at this point? And the answer is yes, it should roll over at this point, but it may not. This would be logical. It comes down to here. May even be logical. It comes down to here and then takes off. I think that would even be an easier trade at that point. But what we're seeing is continued economic improvement when you look at some of the numbers that come out every day, just in general. Now, there are some hiccups along the way. China has actually disappointed in the last couple of weeks here. But overall, the data continues to improve, housing continues to improve, and the stock market, more importantly, besides analyzing the data, more importantly, keeps going up. It's real easy to look at the data, make a judgment whether you're going to be invested or not. But I think overall, you have to look at what investors are doing. And right now, they're buying more stocks. By the way, if I didn't say it's the beginning of the podcast, I'm having a major allergy attack, so if my voice is a little deeper, if I clear my throat a little bit, sorry. I guess you can turn it down if it annoys you, but I'm just having a severe allergy attack, but that's the name of the game. That's how it works here in South Texas. Now, part of the reason that the stock market continues to run, and it's almost as simple as this. This is the S&P 500 in blue. And then, and this goes back to 2006. This is the jobs report that we get monthly. And I don't have this updated for the one this past week, but it was, I think, 236,000, something like that, so it popped back up. But you can see the tight correlation between the jobs and the stock market. Now, even if these numbers are manipulated, which a lot of you believe they are, I'm not going to agree or disagree right now, but I would say that the numbers back here were manipulated, back here were manipulated, and so this is kind of apples to apples, but the bottom line is that the stock market is very correlated with these jobs numbers. Now, if you zoom in on any year, you could see that jobs were moving sideways. For example, 11, and the stock market still sold off. So this isn't meant for swing trading, day trading, trading for the next 2 months. This is just in the big picture. Why is the stock market going up? Well, obviously it's more buyers and sellers, but part of the reason is because jobs have improved. Now, you and I know that we're not ultra bullish all the time, and we don't wear these rose-colored glasses, right? We look inside the numbers. We know that there's more people working part-time instead of full-time. So there's a lot of people who wish they had a better job, wish they were getting paid more. Also, people working second jobs. There's a lot of people out there that are working second jobs because the first job isn't paying enough. They're not working as many hours as they would like. So there's a lot of problems with the quality of jobs in this country, and that's a long-term problem, and that's why the Fed is really, I don't think the Fed's going to stop anytime soon because they see that. But the bottom line is we still have this tight correlation between what the stock market is doing and what the jobs market is doing. I've got two different things on here. I've got the ADP, and I've got non-farm payrolls, and you can see that in general they rise. Now the jobs you can see are kind of leveling off here. But look, this number that came out last week, popped this up here. So again, this is not meant for a 2-month trade. This is meant zooming out the 30,000-foot view, what's going on. And this is one reason why the stock market continues to rise. I did a speech last week in front of a group of people, and a group of professionals mostly. And one of the things that I showed them was that this stock market, despite the fact that it is continuing to go up, is that the long-term moving average of the S&P 500's PE ratio. So if you look at the PE ratio over time, this is the 80s when stocks got very, very cheap. And this is what happens with stock markets. They ebb and flow between ultra cheap and ultra expensive. And we're still in this process of stocks becoming cheaper. Now, you may say, well, I thought the stock market has been rallying the last few years. How could this be going down? It's because earnings have been rising at a faster clip than the prices. So the E is going up faster than the P. Hence, this ratio continues to fall. Will it get back down to 10 before we say, hey, all in, buy and hold, let your guard down? It may not get there. We don't have a lot of data when we look at these long-term charts. But this is something that I made that I look at because this is, to me, the deleveraging process. This is when stocks were dramatically overpriced. People, remember, for the same amount of earnings in 1980 as 2000, they were paying 2.5 times more for that same amount of earnings. Now they're paying, 17 times earnings, and it's continuing to fall. And so stocks are continuing to get cheaper in the long run here. And look, a lot of companies are in great shape. When you look at some of these companies and how fast their earnings are going up, their profits, their dividends, a lot of good companies out there that aren't very expensive. Now, we have a lot of headline risk. We saw, and I won't go too much into it, but we saw the Cyprus, this tax going into place over the weekend. We don't know how that's going to affect the European banks. Is there going to be a run on those banks? People take their money out of those banks in fear of a levy of some sort from other banks. So again, we're one crisis away from the stock market rolling over and having a 10 or 15 or 20% correction. And so that's why we have all these systems in place. That's why we don't just buy and hold. But so far in 2013, buying and holding has worked very well. But we know that when we kind of capitulate and just throw all our money in there and don't have an exit strategy, that's just the time it's going to roll over. But in general, stocks continue to get cheaper. And I don't know where this will bottom out, but people still at this point don't have the enthusiasm for the stock market that they did back in the late 90s. Now, when we flip over to bonds, this is something else that I've showed on the blog before, and it's the long-term bond PE ratio. And it's obviously a made-up number as far as there's no such thing as a bond PE ratio, but it's essentially taking how much interest you're getting, how many years will it take back for you to put money in, get your principal back, how many years would it take? And you can see back in 1980, bonds were extremely cheap. Interest rates had risen 7 times here. We got up to about 70 last year, and now we're at about 52. So even though rates have risen, you can see that they have not risen enough to make bonds a good deal. Primarily, a lot of the bonds that I'm buying are things like floating rate types of bonds. I'm buying very short-term, undervalued corporate bonds where I don't have to worry so much about treasury rates and where rates are going. I'm more worried about the quality of the company. So, but in general, if you're sitting there not protected from rising rates, or if you own a bunch of bond funds, you need to be alert. Rates have started to creep up. They may not race up, but they've started to creep up, and they may just persistently do that, and we may see interest rates just trickle on up. And so be careful if you're in some things that are not hedged or are different or the wrong types of bonds. All right, we talked about oil. I think on the last podcast, bottoming out somewhere around $89 would be a good support area. That's indeed what has happened. Oil has bounced from 89 and change up to 93 and a half. And, with that, some oil stocks have been rallying as well. So, again, logically, looking at this from a technical perspective, we would get up maybe in the 97 range and then either break out or reverse course and maybe even go down. And right now it looks like it should be going up based on the fact that some of these things have lagged the market. Some of the commodities have lagged the market. And look, some of the bulls think that's the bullish thing we have going, is that we have the economy getting better, but we don't have, and we still have the Fed there pumping money in, and yet we don't have commodities going up, and so that's been a real help to the consumer. But just as fast as oil prices went down in February, they're now rising in March. So that's a quick look at oil. Here's a picture of interest rates, and you can see they've been just continuing to trickle up, kind of the old 3 steps forward, 2 steps back. And that's one thing that you don't hear talked about very much is what happens if rates don't. Everybody expects this V-bottom where we're going to get massive inflation and interest rates just spike up to the moon. What if they just trickle higher and they're very persistently moving higher? What happens is bonds continue to perform. I think stocks do really well in that environment. Stocks wouldn't do well if interest rates rose too fast. We know over time, looking at history and studying this, that when interest rates are rising, stocks don't do very well. In fact, when the Fed is hiking rates, interest rates have a 0% return over the next couple of years. When they are being accommodative or dropping rates, they tend to average a couple of percent a month over time. And so stocks do very well when the Fed's out of the way, which they obviously are right now. They're being very loose with their monetary policy. But if interest rates just trickle up, I think stocks can still do well. And so that's something to watch, because that's what's happening right now is they're just trickling higher. All right, let's take a look at Apple. It got a little bit of pub on, which is kind of funny to say because it had so much pub seemed like all of 2011, 2012. Apple, of course, Samsung came out with their Galaxy S4, kind of mixed reviews on it. Apple got a pop, kind of legendary value fund manager Bill Miller came out and said that he thinks Apple is a value now. And so Apple had a nice day, up about $11, partially because of that, partially because the Samsung review was mixed. I've been saying, look, I think Apple, at the very least, may have a floor put in simply because if you're somebody that's just looking for a trade, you may buy Apple because they're going to do something with their cash. I mean, if they came out and said, we're going to pay one-time $50 a share or even $25 a share dividend, which is a 5% jump, the stock would jump up, you get your money, and you'd sell it. So they're going to do something with the cash. My biggest concern is why aren't they out there buying tons of stock back? I don't want a big dividend. I wouldn't mind if they increase their dividend as a yield over 3% because they have it and they can do it. But I'd rather see them buy a bunch of stock back. If they thought the stock was so undervalued, why should they give it to us and have us be taxed on it? Why not buy their stock back if they think it's such a great deal? And they're not doing that. So that's a concern. But I do think, and I've said this before, a viable plan to what to do with their cash going forward would be one thing to get the stock going. Number two would be a wow product, and they're probably going to come out with a bigger phone, something to compete with the Galaxy S4, which I would be very interested in personally. And by the way, I think they may come out with a smaller, cheaper phone that will compete internationally, more of a plastic phone. So those are that kind of that wow product may be coming out, maybe an Apple TV, maybe a watch, whatever the case. And I think the third thing is just this technical move. If it breaks above here, comes up, and then maybe pulls back a little bit and then starts to go up, that's your time. But look, again, if you look at this unbiasedly, or is it non-biasedly? Unbiasedly? I think it's unbiasedly. If you look at this without a bias, how about that? What you will find is it's very hard to find a company with the type of metrics that Apple has at this level. Very, very difficult. There's plenty of faster growing companies out there, plenty of companies with maybe increasing margins, whereas Apple's have been decreasing. But overall, this is still a stock I think you hold, and would have been great to get out at $700. But I think if you have some powder dry, it's getting very close to, for me anyways, to adding to my position and lowering my cost basis. So that's exactly what I'll be doing at some time here very soon, because I think it's getting to that point now. Now, if we look at it a little longer term, of course, it could go down to the high 300s, because this was the area. It kind of had some congestion back in late 11. Then it really broke out, and you can see what we've given back is that massive breakout. That was a period where stock just went parabolic. Hedge fund managers were using it as a cash surrogate. Anytime they had cash, they would go dump it in Apple. So that has given back. Now we're back to basically that hasn't happened. And some people are calling this the organic split. Apple did split its stock. It just happened naturally, and you didn't get any more shares. So, but we could end up in this range as high 300s first before it bottoms. But keep an eye on it, because I think it's getting to this interesting level. And it's had a couple of kind of fake times before where it looked like maybe it was going to break out, and it didn't. But I think you're starting to hear now, even the people that thought Apple could fall a little further are now starting to say, hey, you know what? Maybe it's time we move on to shorting something else. It's very hard to short a company with $140 billion of cash, which is a quarter of their market cap, and it's just crazy, some of the metrics on this company. So again, there's other companies doing maybe more exciting things right now and growing faster, but I think as part of a piece of a portfolio, this Apple still makes a lot of sense. All right, we'll finish up with the VIX, which continues to fall and could get a single-digit handle on it as it falls below 10 at some point. Now, a lot of people have been whipsawed on this, continue to buy the VIX, want to buy the fact that they think it's going to rise, and so they keep buying it only to see it fall further and further. And now we're in the first time we've seen this in a number of years, but the 10-week moving average, which is the orange line here, has dropped below 15. And really the last time that happened was, the last time it was below that was 07. So we've been in this, kind of like interest rates being below average maybe. The VIX maybe was above average for the longest time. Of course, in 07 and 08, it went up into the 60s, and we've had spikes into the 30s several times. And so naturally, when it got down to the 17 level, right in here, a lot of people bought the VIX, and some did very well on it. But when you buy the VIX anticipating that we're going to get these spikes, and then these spikes kept getting smaller and smaller, perhaps we're in a new era where we're in a low volatility world. And you can see the 10-week moving averages drop below 15. And again, and I've pointed this out in a prior podcast, but we spent 05, 06, and part of 07 in a low volatile kind of thing. And look, the stock market did very well in 05, 06, and 07, a few spikes, but did well. So could we be entering that as we move out into the future? And I think it's a high possibility. Because why? Because people don't think that. The biggest concern right now for investors is there's two sets of people, I think. And I'm not one of these. I don't fit in one of these categories, and I don't think you do either if you've been following the podcast. But there's a set of people who are invested, and because we're at the 07 highs, immediately want to sell because that seems like the natural thing to do. That's what makes the most sense. Then there are those people who have been out since 2008 and are completely sitting out and don't know when to get back in, and they see the news that the stock market's at those 07 highs. Don't be either one of those people, because if you sell right now just because it's at these highs, the market could keep moving up without you. On the flip side, you're kind of this all or none person sitting completely out, haven't invested at all, and I've met a few people in the last few weeks that are like that, and I've said, hey, can you help me? Because I don't know when to get back in. And the thing is, what you want to be is in between. And again, I've talked about being agnostic. You want to acknowledge the market for what it's doing, participate in it, continue to have your exit strategy, continue to have your income, realize that we are in a secular bear market, and maybe we're on the upper end of this secular bear market, but the market could move higher. And so let's participate, but again, have this exit strategy and a system in place. And if you do that, then you don't have to worry about trying to call the top or being stuck out watching the market go up without you. And I think if you do that, you're going to be very happy. You're not going to worry about the daily, news events coming out that could affect. I mean, look, this deal over in Europe now with these banks and these levies, that's something that could affect the market, but let's let the market dictate what it's going to do. And then again, our systems will kick in and tell us what to do, as opposed to us trying to be a fortune teller. All right, guys, have a great rest of the weekend. I'm going to try to drink some hot coffee and clear up my throat. So, hey, don't forget, karleggers.com, twitter.com. We're on Facebook, iTunes, Google+, eggerscapital.com if you want to check out more information there. So thank you very much. Appreciate it. We'll talk to you soon.